If you're unfamiliar with GARCH models, I have a dedicated video to it on this channel. I'll leave a link to it in the description below. But take a look at the GARCH volatility forecast and the classification of regime. It does a pretty darn good job. It's color coded here into low, mid, and high by blue, orange, and red. And if you take a look, you can see that in the higher volatility regimes, the distribution is spreading out. It has a higher variance, increasing the likelihood of extreme moves. How effective is this? Well, if we use a conditional regime model to find the probabilities of these tail events, we get an expected 12 and a half days in a high volatility regime to observe these crisis events relative to what? 7,000 years from the low volatility regime. In other words, regime modeling is actually better capturing the dynamics that we experience in practice. This is literally making it possible to have, in a model sense, observed this data. If we were to use static parametric modeling, it would have taken on average 7,000 times 19 years to have observed the data that we already did. Clearly that model is completely incorrect, but now it is extremely possible, even according to our model. On average, 12 and a half days to experience one of these extreme moves in a high volatility regime. That is the entire purpose of regime modeling, to better estimate distributions, probabilities, and statistics. You're still not going to have nice asymptotic classroom convergence. Law of large numbers, central limit theorem, they don't hold. But your distributions, probabilities, and statistics are going to be certainly more reasonable, right? You're always subject to model and parameter risk anytime you build a model. That's not anything you can ever get away from. And there's always discretion upstream to try to figure out what kind of risk you're willing to assume. But this is making the data we have observed actually possible, not in an overfitting sense, in an actually capturing the dynamics that we experience sense. That's a really important idea. So the full scale failure of static parametric modeling implies that we need some form of regime based modeling or conditional modeling at least to better capture these dynamics. All right. But that's easy then, Roman. Like, we'll just go ahead and do our regime based modeling, and we'll use some sort of walk forward mechanism to discern whether or not we're overfitting, and we'll be good to go. Okay, what's the problem with that? Regardless of whether you use conditional modeling or you use raw empirical probabilities, they fail in prediction. Our goal is never prediction. Our goal is positioning for survival. No amount of walk forward testing is useful here. No amount of statistics can predict the future. None. If you're targeting a role as a trader, market maker, quant, or you're just looking to grow and protect your portfolio in all market climates by applying quantitative strategy, Quant Guild has 2 crazy free resources available to you. When you get started, you can pick your track. You can always change this later. If you're looking to break in, head on over to the Quant Roadmap. Every topic in the right order that you need to know for success in different roles. You can select them here. It will tell you the exact breadth and depth of knowledge you need in each for success in interviews and the career as a whole. And of course, if you're looking to grow and preserve your wealth, you're going to want to run your own personal hedge fund. This isn't a day trading strategy. It's structure institutions use every single day to cut their downside risk in half, improving their overall long run return. I have a free quant research note available to you on this page for exactly what is going on. Link in the description below to Quant Guild if you're interested in these free resources.